Hello. Thank you everyone for attending. Our topic for this podcast is how to use leverage to achieve real estate wealth. This is SeeWing Yee from the Yee Real Estate Network. And our special guest once again is Mr. Richard Advani from Supreme Lending. And just so you know, Richard Advani and his company is one of the leading real estate consultants in the nation, and his company does investment loans in all 50 states. In addition, he also does owner-occupied loans as well throughout the country. So, and he has done many loans for our investors. He has done many loans for many other real estate investors throughout the country. He's part of many networks of real estate investment clubs throughout California, mainly, but he also have investment clubs that he worked with, and he also get tremendous amount of referrals. He does outstanding loans. His company and him know all about real estate investors, what are their goals and what market to purchase, and he himself have multiple investment properties. So without further ado, the topic is once again how to use leverage to achieve real estate wealth for investors. Now, as I've been doing this over the years, I find too many people take things for granted. Americans do not realize what they have in place. I mean, anyone can achieve the American dream. And in my opinion, and in the opinion of Richard Advani, my special guest here, the best way to achieve real estate wealth as an investor is to use leverage. And use leverage mean use financing, use investment loans to buy multiple properties so one can retire with financial freedom using real estate, which is the best way to retire. The real estate is the number one wealth building tools in the history of the world, in the history of America, no matter how you put it. So without further ado, Richard Advani will discuss why leveraging investment loans and financing is such a critical component for real estate investors, especially in today's challenging real estate market. So without further ado, welcome Mr. Richard Advani. So tell the audience why you feel using leverage, using loans is the best way to achieve real estate wealth.
Absolutely, SeeWing, and yeah, nice to chat with everyone again. So besides the obvious, which is, hey, most of us don't have 2, 3, 400 grand, $1 million in cash to buy a piece of real estate. Leverage, of course, allows you to buy real estate for, a fraction, 20%, 25% of what you're actually purchasing the real estate for. So obviously it allows you to be able to enter the purchase market. But I'd say it's interesting, and I have an interesting stat to share. And actually, I don't have the specifics on the stat. I was trying to pull it up right now on the other computer, but it's not working. But this stat actually was into the training for getting a real estate exam, and it basically talks about the difference in return between the stock market and the real estate market. And over, I think it was from the late 80s to early 2000s, basically the stock market had returned 700% in that period of time. And real estate during the same period of time had only gone up 200% or 250%. And so right away, you're like, oh, wow, stocks was the way to go. Well, yes, except for the fact, once you factor in leverage and the fact that, hey, to buy $300,000 worth of real estate, you only need 50 or 60 grand to do it. Whereas to buy 300 grand worth of stocks, you need 300 grand, right? And so once they actually factored leverage into play, the return on investment for the real estate, once again, because that piece of real estate went up, 200 to 300% in that time period. But the amount that you actually put down in that scenario, the return on investment was like over 1,000%, right? So it completely smoked the stock market. And that really, I think, is a good demonstration of obviously what leverage can do. You know, a lot of us have bought a lot of real estate over the last 2 years, and it's interesting because the same property we bought for 200,000, man, even a year ago, I feel like today is 250,000. Now, I bought a bunch of those properties as well. So I bought $200,000 properties where I put 20% down, you know, so about $45,000 down. And a year and a half later, I've made more than the $45,000 just in appreciation. And, you know, once again, that gives you an idea of what leverage does. You know, what's my ROI if I've already made back my investment in equity, if I wanted to sell, not that I'm going to, you know, it's infinity. You know, I've doubled my money in a year and a half. And that's not including, of course, the fact that, you know, I'm paying down the balance every month. And I don't mention rental income on the front because, look, a lot of times in this market, to buy in strategic growth markets, to buy in Texas, to buy in Florida, you may not be making a front end return like we're used to, you know, of 5, 6, 7% plus. A lot of times you're making 1%. Like the example I just gave, you know, those were Texas properties. I'm making $50 a month on them, but I knew what I was doing. And I knew that with leverage, obviously, I can buy this property with a relatively minimal amount out of pocket and stand to be a part of the rapid growth and appreciation happening, you know, in all across the country, but, you know, in areas outside of Austin. So, yeah, leverage is definitely a way to go. Obviously, I'm in the leverage business, so of course I'm going to say it's good, but statistically look at it, it's good. From a common sense perspective, it's good. You don't want to over leverage. I think where people can get in trouble is, you know, they buy these properties, property values go up, you max it out to 75, 80%. Again, you use that to buy more properties at max leverage. And a lot of real estate gurus out there will preach that as a strategy, right? And I know a lot of people just going nuts, buying every single thing they can, maxing everything out. And right now they're like, yeah, it's working. Well, we've only been in an up market so far, right? What happens when the market does turn at some point? And it's a temporary turn, right? This is what the market does. You know, it's still always going up. So, you know, and the good thing is SeeWing also doesn't recommend, you know, we recommend investing aggressively, investing to your comfort level. But, you know, I'm not a big fan of re-leveraging and maxing stuff out. Now, look, if you owe 40% on your home and you want to take out 100 grand and it'll take you up to 60%, still leaves you an exit strategy, I'm all for that. But yeah, I think I don't know how big of an answer you're looking for here, SeeWing. I could probably take over the whole webinar. But what are your thoughts to what I've shared so far?
Yeah, I mean, yeah, from you as a loan advisor, as a loan consultant, yeah, is a very important team for real estate investors. Yeah, what you say is basically correct. You investor have to know the numbers. So that's why investors have to diversify their real estate portfolio. You know, you know, if you, I mean, let's use the example of 10 loans, Fannie Mae lending guideline, for example. Of course, Richard going to talk more about that. But I'm just giving you a simple illustration what an action plan may look like, assuming, you know, investors have enough money for the down payment. So a 10 mortgage lending guideline, Fannie Mae lending guideline, which is best interest rate and all that. So that 10 mortgage, you know, so an investor have to decide how are they gonna acquire that particular portfolio of 10 houses. It doesn't have to be a single family home investment. Could be it could be 1 to 4 units. Again, Richard will discuss that throughout this presentation. But the 10 private portfolio, I would say, a situation, you know, one might buy, you know, 2 rental properties in Texas and 2 in Florida, or 2 in North Carolina somewhere for high appreciation, low cash flow situation, and then they should go into a Midwest market, right? Midwest America, where the prices are much lower, where you can buy a single family home or duplex for only like, you know, $60,000 to $70,000 with very, very high cash flow, as opposed to a $250,000 new construction single family home in Florida and Texas, with a, you know, with a mere $1,700 rent. So so you offset high cash flow portfolio in the Midwest, right? Low purchase price, very, very high cash flow to offset the other portfolio in Florida and Texas where the prices are higher with the new construction, for example, and then the cash flow and the cap rate is not as high. So that's how you balance your portfolio so you're not over leveraging. So with that in mind, Richard, I know the past 18 months, we have a historical low interest rate. So the record low interest rate, as a matter of fact, and we've been hearing, low supply of inventory throughout the country, high demand, and record low interest rate. So Richard, can you briefly explain about about the interest rate? That's the main reason why so many people, there's so much demand. But from what I hear, the right now, if you are an aggressive real estate investor, you need to load up, right, in your portfolio acquisition, because, like I said, it's record low interest rate, and then also the rates can go higher. In fact, one of the main contribution where the real estate market could be affected adversely is when interest rate will go higher. How much higher? In my opinion, maybe around 5%. If the interest rate goes to 5% or above, then we may see some correction in the real estate market. So Richard, you are being in a loan business, so it's really your job to understand the interest rate market and the Fed, the rate, how the Federal Reserve, how they determine interest rate. So how long you think this low interest rate environment will continue to happen? I mean, I know you don't have a crystal ball, but in the next 12 to 24 months, what do you think about interest rate with respect to mortgages?
Yeah, I mean, I think interest rates are expected to stay pretty steady throughout the end of the year. We are seeing the 10-year Treasury, which is kind of the gauge marker of the 30-year fixed, move down in the last couple of days from a high it hit. But you got to keep in mind, I mean, right now at 25% down on conventional loans, you can get in the high 3% range, 3.6, 3.7 rate in APR, which is, prior to the pandemic and prior to this recent crazy rate drop, we were at historic lows. And at that time, the lowest you could get a primary home was 3.6, 3.7. Now we're getting rentals in that same interest rate range. So, even though we're up a little from the bottom of the last year, we're still extremely low overall. We're lower than we were a year and a half ago, and that had been all-time lows. So my hunch is we could see rates move up this year up to about 0.5% higher than they are now. But by the end of the year, I think we have the whole year at the current low interest rates. But I'm not an economist, of course. But I tell my clients, if they're buying properties into early next year that they're in contract for, that prep for 0.5% over what I'm quoting today. But that 0.5% over still puts you in the low to mid 4% range, which is crazy. 30-year fixed, low to mid fours. Once again, that was a little higher than where primary home rates were at the lowest. So I think rates should hold steady for a while, but with property values going up as well, once rates do start moving up, it is going to get harder to find cash flow. So it's important to strike now while you can, while you have the low rates, while you have obviously the growth in the market.
Yes, I agree. So right now, I know we're talking mainly investment loans, but primary homes owner-occupied interest rate are still in the low threes. So for those people in a primary home market, the rate is amazingly low. Investment loan rate are a little bit higher, as we all know, because of the higher rate risk of associated with doing an investment loan. So Richard, can you explain to the audience with the Fannie Mae lending guidelines, which is the best for investment loans these days? And not only that, in fact, let me break down the questions I'm going to ask you. So can you break it down, like for single family home rentals, what is the typical down payment? I know everybody's situation is different. What's the typical down payment minimum requirement, and also the typical interest rate for single family homes? And then the next sub question I'm going to ask you would be, what about duplex to fourplex investments, what are those minimum down payment for that, and what are the typical interest rate for that? And finally, Fannie Mae lending guideline only allow 1 to 4 unit. If any investor will want to buy more than 4 units, you'll no longer qualify for the Fannie Mae preferable lending guideline. So, so if you can, Richard, if you could answer that 3.5 questions I just posed to you.
Yeah, so I don't have a specific pricing information, so I'll kind of give ballparks on that. But for single family homes, the minimum is currently 20% down. It was as low as 15% down, but a lot of that kind of transitioned out with the big Fannie Mae changes that occurred a couple months ago now. So 20% down for single family homes. You can still get those interest rates in the low 4% range, sometimes even the high 3s. 25% down on a single family home will get you the best pricing, generally in the mid 3% range. And then for multi-units, typically you are looking at 25% down at a minimum. And those interest rates typically same in the low to mid 4s. Rates are higher on multi-units versus single family homes inherently. So that's why 25% down the multi-unit is low to mid 4s versus 25% down on the single family home in the mid 3s. Yeah, overall, in terms of guidelines, the main thing that we're really looking at is what is your income in relation to your debt, right? And by debt, we mean things that report on your credit report. So car loans, student loans, and so forth. Your mortgage for your primary home. And typically we like that to be at about 50% of your monthly income. So 50% of your monthly income you can't exceed that with, once again, those monthly debts. One thing that's interesting is we've been doing a lot more of the non-QM and non-Fannie Mae loans. And this may sound a little crazy, but for properties that are at least break even in terms of cash flow, we can do a no income documentation loan. Like nothing. It's just based on the property itself. And the interesting thing is I priced up 30-year fixed in the mid 4s, which is crazy on the non-Fannie Mae, non-QM product. So that means you could have unlimited number of finance properties. There's no limit. You can close very quickly. And the interest rates are still pretty amazing. I mean, those non-QM products historically have always been 6.5%, 7.5%. So, yeah, that's a great product. And I'm sure a lot more people are going to get use out of it. We've really been blown away in how quick we're getting those approvals coming out too.
Yeah, so those non-qualified loans are not within the Fannie Mae lending guideline, as I understand, even though it's a no-doc loan, but one still need to have good credit. Is that a good FICO score?
You have to have very good credit.
Yeah, okay. But for whatever reason, those individuals may not have a W-2 income, or their tax return may not show sufficient income to qualify, but they do have enough down payment.
Yep.
And they have good
or
credit.
They just may be over 10,
What's that now?
I said, or they just may be over 10 properties.
Right. Oh, I see. Oh, that's great. That's really good. By the way, with respect to single family home rental financing, what is the minimum loan amount to buy a single family home rental for investor?
If this was a week ago, I would have told you 40,000, but we did get some exceptions recently for slightly under that, in the high 30s. But I would, soft rule of thumb, assume 40,000. If you're close to that amount, maybe ask the seller for a seller credit and bump up the loan amount instead to get you over that $40,000 net loan amount.
So Richard, as I understand, $40,000 loan limit. So if one were to put minimum 20% down for single family home investment, so if you calculate a little bit backward, so the purchase price of the house is probably 55,000 or something like that, or 60,000. Is that the 60,000? Am I right? Something like that. 60,000 multiplied by 20% is $12,000. Even less than 60,000, maybe around $55,000 to $57,000 purchase price of a single family home. You can do 20% down, and your company, your lender, can get the financing done. Am I correct?
Yep, that's correct.
Yeah. Okay. So another question I have. I know we can conclude in about 5 to 7 minutes. I don't want to make this podcast longer than 25 minutes. If you, from time to time, I have some aggressive investors, ambitious investors, which is good. In fact, I sent you one this morning. So an investor, they want to maximize the market opportunity right now. Some of my investors, they want to get 3 or 4 properties all at one time with financing, with loans. So if I understand you correctly, you can do it. Your company, your lending, you can help investors to get multiple mortgages under contract, under loan transactions, 3 or 4 even, or even more, all at one time. They can do that, right? And so why is that doable?
Yeah, we absolutely can. And, we have the ability to use projected rental income on the property that you're buying, even if it's not rented out yet. And the reason why that's so crucial is normally, people in the industry hit your full qualifications with the payment on this rental you're buying, right? So they hit you at $1,500, $1,600 a month, whatever the payment is. And that makes it harder to qualify, and buying 3 at once and getting hit with 3 of those full monthly payments without having the ability to offset the rent. Even if you're making a lot of money and you have very low bills, it's hard to buy 3 rentals at once getting hit with all those payments. So we have the ability to use projected rental income, which now means instead of that rental you're buying being a negative or a hit to your debt to income ratio, it's actually a positive, or it's kind of a net, no, it's a wash, which means your debt to income ratio doesn't go up with each acquisition. Therefore, now you have room to buy 1, 2, 3, 4, 5 at a time, potentially, depending on your specific scenario.
Yeah, of course. I mean, is this just your lenders that can do that, or just because you have your business model, your company run in, you understand investment so well, it's just you have this kind of a niche product available that many other lenders in other part of the country may not have what you have. Could that be a possibility?
No, I don't think that's too much of an impact.
Mm-hmm. It's just that you specialize in investment loans, so you understand how to do these kind of things for investors, right?
Oh yeah, no, absolutely. Sorry, I didn't quite hear what you said the first time. So yes, obviously, having rental properties myself, but also specializing in working with investors the last 13 years, and my team who's with me, that's all we do. We eat, sleep, breathe investor loans. And more importantly, the processors, the underwriters, all of the back end with us also does investor loans all day long. So it's funny, sometimes people will go to a different branch of the company I work for in a different state, and they'll say, oh no, you can't do that, you can't do that. And I'll get the client calling me back saying, well, talk to someone else in the same company, how come you can do it and they can't? Well, it's not that I can do something they can't. They don't even know they can do it, because if you sit in a bank and you work, in the mortgage department, everyone that walks through that door 99% of the time is going to be a primary home buyer, which means most of the business you bring if not all the business is primary home buyers, which in turn means your underwriters and your processors, that's all they're seeing as well, because that's the type of business you bring in. So you bring in an investor loan that's outside of their wheelhouse. They're not going to know the intricacies of working with investors and all the small little guidelines that you have to find by digging through 500 pages of guidelines. But given that we operate in that space all the time, we know the extent and limits of what is possible, what's not possible, which allows us to have very, very, very effective consultations up front. When a lot of our clients are selling 2 properties at once and buying 12 with them. And it's all happening in a short period of time. Sometimes they're job changes, sometimes they're selling companies, and they're engaging me, a year before it all actually happens. And, a lot of the moves they make is based on, that broad strategy that we discussed. So if we didn't have such a good handle on investor loans, we wouldn't be able to help people plan. And a 1031, I mean, you're planning at least 6 months in advance. And that's when everything actually goes lights on. In all reality, most people plan a 1031 9 months at a minimum in advance, to sell the property and everything else. So it's very important not working with someone that that you don't work with someone that doesn't have experience working with investor loans, period. And unfortunately, in the sales world, everyone's going to tell you, of course I work with investors. Check their credentials a little better. A great question too is if someone says they specialize in working with something, find out how many rentals they have. I was referred over to an investor-friendly CPA. I remember a couple of years ago, and I start talking to the guy within the first 10 minutes. I'm just like, oh, well, how many rentals do you have? Because he's so into, obviously into that niche, and he didn't have any. And I was like, I didn't end up working with him, needless to say, because I want someone who understands it from every perspective. That way they can offer me, more value than the traditional person in that position or the loan officer, but also help me plan more effectively, because that planning can save you hundreds of thousands of dollars sometimes. I've saved people a lot of money because of mistakes that they would have made if we didn't have those high-level conversations.
Yeah, absolutely, Richard. You and my network, working together for several years now, and you have done many investment loans for our investors. And as a matter of fact, some of the investors you work with that we sent to you, you are doing the multiple loans. I mean, multiple on a consistent basis. So you are not a typical loan salesman, you are a loan advisor, right? I mean, you provide value, you understand the investment goals and objectives. So you do a lot of multiple loans as we speak. I have several investors already that you're working with. They are doing multiple mortgages all at one time on investment property. So you always come through and do a good job. One more thing, the ideal scenario, we only have 5 minutes. I keep saying that. There's so much to cover each time we do a podcast. That's why we have to do it once a week so far. So
that's the one now that SeeWing and I have to get dressed up.
Yeah, just once a week. That's all. Okay. Don't know what's underneath our shirts. Anyway, you don't want to know. Okay.
Slippers, shorts, I promise.
So the best case scenario, I know, I mean, it's easy for us to say 10 mortgages, action plan, whatever, but some of my investors, I work with, both husband and wife works, and they have a good income, they qualify with good credit and good loans and all that, and they have a down payment, which is not easy, right? It's not easy to put up 25% down payment for 10 or more mortgages. That that's quite a bit of money. Not every investor have those kind of money, but we do. So the best case scenario, in fact, I have several investors that we're working with you, Richard, or about to. Some of them, they have like the wife the one spouse gonna obtain the first 10 mortgages, the Fannie Mae lending mortgages, under her name only. Or when that person finished with the 10 mortgages, Fannie Mae lending guideline, then the other spouse will use his or her credit and name to buy the next 10 mortgages under the Fannie Mae lending guideline. So we have a total of 20 mortgages potentially for investment loans. And not only that, so each loan, you can buy either a single family home or duplex or triplex or up to a fourplex, and still only qualify as one loan. So some investors, they want to, how you say that word? They want to economize. No, that's not the word. What's that word? It's not leverage. They want to, maximize the mortgages by having a lot of doors. So if one mortgage could potentially equal a fourplex or threeplex. Imagine, a 10 loan under Fannie Mae guideline, you could produce like 25 to 30 doors, right? So you buy a combination of single family home, duplex or triplex or fourplex, 1 to 4 unit on a Fannie Mae lending guideline. That's how you, I forgot, that word, how to not leverage, but anyway, you know what I mean? So can you kind of recap that maximization of the both spouses getting 10 mortgages each on a systematic basis, and and really.
Yeah, absolutely. You know, as we're stressing with this call, leverage is obviously such a powerful tool, and the best way to get leverage on rentals is with conventional Fannie Mae, Freddie Mac loans. The agencies, as they're called, allow you to have 10 finance properties per an individual. So contrary to what most people typically do, you know, we don't recommend you go joint on the mortgages with the husband and wife, because when you do that, each joint mortgage counts against both people towards the 10 limit. So essentially, if you have husband and wife and both parties are working, what we try to do is have the husband qualify for his 10 mortgages, and on those purchases, the spouse still is on title as an owner. They're just not on the loan, right? And generally what the strategy is, whether you plan on buying 15 or 20 properties or not, it's still a good idea to keep that door open versus closed. So typically what people will do, the husband will buy just under his name, or the husband and wife will alternate. But basically, if you divide and conquer as it relates to the financing, now instead of getting 10 conventional low interest rate loans, now you can get 20. So it's a great strategy to employ, and we have a lot of our clients definitely proceeding with that strategy.
Yeah. Oh, excellent thought. Oh, wow. You provide such great value and great content each time we do our podcast together. I just gets me inspired and excited, Richard. This word just came back to me. The word is scale, economy of scale. Each investor, once you create your real estate plan, if you want to maximize up to 10 mortgages per person, you need to scale your portfolio. That's how I describe it. Remember this word, Richard, scale. Scale, economy of scale, maximize each loan with 1 to 4 units, assuming you can afford it with the down payment. So here's the, Richard, are you there? I only see your name.
I am.
Can
you lose me?
Yeah, okay. Now we're back. So here's my takeaway, Richard, and then I'll ask for your recap. My takeaway for this particular presentation, OPM, other people's money. Investor using OPM, using the loan. You put only 1/4 or 1/5 of your money to buy the whole asset, and the lending part of it, the lender will leverage you with the record low interest rate. Is almost, quote unquote, is almost free money. The low historical low interest rate is almost, in my estimation, is free money. I mean, why not? Why not leverage with the OPM? Why not, just make your money work smart and work hard? And that's how you, in my mind, in Richard Advani's mind, that's how you generate wealth, create wealth in the fastest, most efficient way. So that's my takeaway. So with the 30 seconds remaining, before I let you go, Richard Advani from Supreme Lending. So what is your takeaway from the high level as we conclude this presentation?
Well, instead of giving a high level takeaway, the reason I was fiddling in the background is I did find the quote that I was talking about regarding the stock market versus the real estate market. So I know we're running out of time, but basically, a lot of people ask what performs better, the stock market or the real estate market. If we can compare the Dow in 1980, it was 830 versus in 2004, it was at 10,000 plus. So huge gain, obviously, on the Dow. It's about an 1,100% gain during that period of time. Whereas home prices in the nation increased about 400% versus that 1,100% gain for the stock market. Once you actually factor in leverage, though, and that most people put on average 10% down on real estate, we're talking about primary homes included, the return on real estate would have been, and these are statistics, 3,000% versus that same time period versus 1,100% on stock. So I think that's a great way to end the call with that statistic. Obviously, it's about leverage and the way you can use leverage to create wealth. And I don't think there's a better indication than that right there. If you did amazing in the stock market, you made 1,100% rate of return over 15 years. If you were in real estate, you would have made 3,000% return.
Well, Richard, that says it all. Nothing else we need to say. It is what it is. These are the factual math behind it. So thank you, Richard. Another great presentation. Thank you for your time. Thank you for everyone listening to this tremendous podcast and how to leverage your real estate into financial freedom. So thank you so much, Richard Advani, for attending. Thank you so much, everyone, to listening. Have a nice day. This is SeeWing Yee from the Yee Real Estate Network. Have a blessed day. Goodbye.